So for the past week, all I've been trying to do is to get my professors to appreciate how transactions affect assets, capital, and liabilities. And most importantly, I discussed with you 11 basic transactions that at least you need to grasp to be able to journey on well with this concept. So you have on the screen here investment by the owner, sale of goods, purchase of goods, buying an asset, taking a loan, settling a liability, paying an expense, receiving an income, drawings, return inwards, and return outwards. So I want to believe professors appreciate it. For some reason, some of you were not so much present during the discussions. The more reason why the videos are there, and even our last meeting, I devoted that for you to watch the videos and be comfortable. So I'm using today's class as a way of revision and answering questions from your end. Because when we zoom into the double entry, we are going to apply this increase, decrease to be able to know whether to do debit or credits in the account. So I'm really taking my time and I expect you to get it before we continue. Okay. Now, what I want to draw the attention of professors is that during the answering of the question, I saw some of you were confused about the check and bank issue, right? Yeah, so there was a little confusion there, which I'll clear when we solve the illustration. Some of you were also, you understood the concept of increase, decrease, but as to what is increasing or what is decreasing, you had challenges there. So let's solve the question, and then as we do that, I'll be explaining the point. So dear professors, all that you are expected to do is to tell us whether the transaction is increasing asset or decreasing capital or increasing liability or vice versa, right? And I indicated to you that each transaction has two effects, two. Every transaction has two, right? So you always need to get that two effect. So let's pick the first one. You could have answered by creating a table where you indicate the transaction. Okay. And then the other columns will be the effects. Okay. So let me merge these cells together. So you necessarily don't need to repeat the transaction. If it is being numbered, you can use the numbers to do that. So here you have number 1, 2, 3 in that order. So you can use the numbering to get it. For those who wrote it, no problem. It doesn't spoil anything or take anything away from it. But you always need to check your time allocation so that you always finish your work on time. So let's take the first one. It says sold goods for 3,550 and the money banked. We sold goods and the money was put in a bank account, right? So dear professors, analyze it. As a business, you sell goods and you had money from that, but you went to deposit it in the bank. So if you analyze carefully, you see that the business is losing goods, which is the stock, and also gaining money into the bank account. So if we weigh the two, then we can boldly say that there is a decrease in asset, which is stock. Okay, that's the goods, but we use stock to represent the goods. And there is an increase in another asset, which is the bank, because we are getting money into the bank account. Okay. So this was what I was expecting. Some of you indicated decrease in asset, but you didn't tell us the specific asset as to whether it was stock or whatever. A few of you were writing goods, which I deducted half mark for that. Okay, so give us the specific asset. A few of you were also writing cash in place of the bank. Others wrote cash/bank. So be specific. If it is cash, cash. If it is bank or check, use bank, right? Let's go to the second transaction, which is a supplier was paid cash of 1,000 Ghana cedi. A supplier was paid cash 1,000 Ghana cedi. If you analyze this, the understanding is that the business is making payment using cash. So definitely the cash is going to decrease, and cash is an asset. So the first thing is decrease in asset cash. Then what is the corresponding effect? We are paying a supplier. Who is a supplier? Someone who gave us goods and we didn't pay. So we owe the person and we are now making the settlement. So if we owe that person, then that was a liability. And now that we are paying the person, the liability is going to decrease. So decrease in liability. Supplier, or better, so you can put a creditor, right? So creditor or supplier, whichever you use is accurate. Please, any question based on the two transactions? Any question?
Please, no.
The third point or the third transaction was one of the receivables gave a check for 2,800. And I think I put under the question that note receivables refer to debtors, right? So let me get you to know that receivables are also known as debtors, right? And then creditors are also known as payables. So note those two words there. So what it means is that a debtor gave the business check. So the business is receiving money from a debtor, right? So if the business is receiving money, definitely there will be increase in assets, but this asset will be bank because we had check. Please don't ever state check, it's bank, right? And then this money came from a debtor, someone who was owing us. So there is also going to be decrease in that debtor's balance, and that debtor is an asset. So decrease in asset debtor. So that's for the third transaction. Okay. The next one, the fourth one, is bought office equipment paying by check. So the business is buying an equipment, and we all know an equipment to be an asset. So if we are buying an asset, then it means our asset will increase. So increase in asset, specifically office equipment. And because we use check, another asset will decrease. So there will be a decrease in asset, which is bank, right? Okay. Fifth transaction. Bought goods on credit from Eunice to the total of 5,000 Ghana cedis. The business is buying goods, right? So the stock or the goods will increase, which is an asset. So there will be an increase in asset stock, which is the goods. And this time we didn't pay Eunice. We didn't make payment. So Eunice will become our creditor who owe Eunice, and that will be a liability. So there will be an increase in liability, and that is creditor. So you always need to state the creditor, and if the name is there, you add the name Eunice. So creditor Eunice. And then finally, we're told that we paid Eunice by cash. So the business paid Eunice the money they owed Eunice. So if that is the case, there will be a decrease in asset cash, and there will also be a decrease in the liability creditor Eunice, right? Okay, so this is what you were supposed to do to score all the points. I think three marks each, so 18 in total. And I think a majority of you did well, 16, 17, 16, 17. I don't know if one person had 18 or 18. A few of you also scored 10. Not bad, it's very good because of few errors. So any questions, professors, before we continue? Questions?
No, please.
Okay, so Portia has no problem. Prof. Abubakar, Akoli, Oswald, Bridget, Austin, Emmanuel, Kujo, Josephine, Eugenia, and Zoe. Are we okay?
Yes, please.
Okay.
Yes, please.
Great. Now,
Yes, please.
great. Before we continue, I want to do this summary for my professors. And the summaries I want you to get is that, you see, so the first summary I want you to get is when you have a transaction that has cash or check, or there's a bank involved, okay? So always note, when the business is paying cash or check, then the asset cash or check will decrease. Okay, that's cash or bank, I should say, will decrease. If the business is receiving cash or check, then the asset cash or bank would increase. So note that when it comes to cash or bank. Okay. Another thing I want to tell you about is if the transaction is one that the business is getting an asset from, maybe the business is buying a building, or the owner is giving a vehicle to the business. Anytime the business is receiving any asset, building, land, whatever, then that asset is going to increase. Okay. So take note of that. And the other summaries is when the business is buying goods, as in purchase of goods, or selling goods. I indicated to you that these transactions can either be on credit, that's where there was no settlement or payment involved, or it could be on cash or check. So note these key summaries. If we are comfortable, then I think I can introduce the double entry principle so that we make progress. So what is the double entry principle? The double entry principle is telling us that, as we have indicated that transactions affect the asset, liabilities, and capital of a business, then this man called Luca Pacioli, I think I have spoken about this man, an Italian monk who became a merchant trading in the olden days, right? Designed this principle or system of recording transaction. And the principle is the double entry principle. Now let's get this principle in perspective. The principle states that for every debit entry, there must be a corresponding credit entry, and for every credit entry, there must be a corresponding debit entry. So this is the principle. If you are ever asked to state the double entry principle, dear professors, this is the double entry principle. For every debit entry, there must be a corresponding credit entry. And for every credit entry, there must be a corresponding debit entry. So the second line is more or less like the vice versa of the other, right? But the key thing you have to pick here is that Luca Pacioli said that if you do a debit on one side, there should be a corresponding credit in the other side. Right? Now, why did he use certain terms and what do they mean? So we have to interrogate what a debit means and what a credit means. But professors, these debits and credits are linked with the decrease and the increase in the asset liability capital we just discussed. But it's important that we know this debit and credit so that we can put things in perspective. So Luca Pacioli said that if you are recording a transaction, you have to use this. So let me draw that on our screens so that we'll appreciate it. So Luca Pacioli says, if you are recording a transaction, you record it in something like this. Okay. And this is called an account. So to Luca Pacioli, all transactions should be recorded in an account. And an account is a T-shaped, format that is used to record business transactions, right? Now, if you look at it critically, you see that there is this side, which is the left side, right? And then there is the right side. Okay. So as you are facing it, your left hand is the left side, your right hand side is the right side. Now, he labeled the left side to be the debit side. He labeled the left side to be the debit side. So this side is called the debit. And then the right side, he called the credit. So I believe professors are noting something now. Okay, so the left side debit, right side credit. So when Luca Pacioli says for every debit, there should be a corresponding credit, what it means is that if you record a certain transaction at the left side of one account, there should be a corresponding entry in another account, but this time on the right side. Likewise, if you record on the right side first, there should be a corresponding left side entry in another account. Please, any questions, professors?
Please, no.
Okay, Josephine, you have a question. Go ahead.
Yeah, please, can you come again?
Is it on the side, the left side, right side, or the principle itself?
The principle.
Okay, so the principle says that for every debit entry, there must be a corresponding credit entry. And for every credit entry, there must be a corresponding debit entry, right? That's the principle. Now, what is left for us to do is to understand this principle. And for you to understand this principle, I'm saying that Luca Pacioli, who was the one who designed this or brought this principle, says that for you to record a transaction, you need an account, right? An account looks like this. It is a T. Its format is in a T form, right? I'll give you the details, what goes into the account. But I want you to appreciate that when you draw your T, the left side is what he calls the debit side. And the right side is what he calls the credit side. So on the face value, when they ask you to make a debit entry, it means record it on the left side or the debit side of the account. And when you see a credit entry, it means it should be on the right side of the account. Okay, so if you appreciate that, we'll now move on to what information you put in the account when you have to make an entry. Okay, I believe we can. Unless there are further questions, then I'll pause for such questions. Okay, so a quick recap is that the double entry principle was brought or developed by Luca Pacioli. In fact, there is a title attached to his name. Let me add it. That's Fra Luca Pacioli. Fra, F-R-E. It is a title for Italian monks. He was an Italian monk, right? But he was into trading. He was a merchant. So he brought this double entry. As a matter of fact, he is seen as the father of accounting because his principle is the backbone of accounting, financial accounting, I should say. So his principle states that when you make a debit entry, there should be a corresponding credit entry and vice versa. Now, you appreciate what a debit entry is when you make an entry on the left side of an account, and a credit entry is when you make it on the right side. So in effect, what Luca Pacioli was trying to say is that if a transaction occurs, you have to do two things. Those two things are debit entry and credit entry. But he says that immediately you do a debit, you have to go and do a corresponding credit. So that was what I was demonstrating here, that if you do a debit in this account, then there should be another account where the corresponding credit is. Right? That is what he was trying to put across. So any questions, professors? If not, I'll pause here and then we'll continue in the next session.